Who doesn't love the idea of making their money work for them, growing steadily over time without the need to clock in daily hours at work? It is a perfect idea, but finding the best dividend stocks to do this for you forever is tricky. Many companies opt for generous dividend payouts to entice investors, but not all have solid growth prospects. Companies sometimes borrow money just to boost their dividend yields, a risky practice that can backfire in the long run, especially when interest rates rise. So, in the quest for forever dividend stocks, it's crucial to focus on two key qualities: sustained growth potential and reliable, sustainable distributions. Such stocks promise continuous expansion while ensuring dividends remain steady and dependable over the long haul. By prioritizing growth and stability, investors can build a robust portfolio poised for lasting wealth accumulation. So, are there stocks that fit the profile? And what else makes them forever dividend stocks? Well, stick around to find out. 1. Microsoft. Kicking off our list of the forever dividend stocks is Microsoft. Microsoft might not be the first name that comes to mind when you think of dividend stocks, but surprise, surprise, this tech giant does indeed pay dividends. Despite its reputation for growth potential, Microsoft has been quietly increasing its dividend yield, which now sits at nearly 1% and has grown by over 10% in the past 5 years. For investors who are drawn to Microsoft's growth prospects, this dividend increase is an added bonus. In 2023, Microsoft showcased its growth potential by leading the charge in the burgeoning field of generative AI, thanks to its significant investment in OpenAI and ChatGPT. While the full returns from this investment will unfold over the years, it's reasonable to expect Microsoft to reap strong rewards. Despite facing antitrust concerns, Microsoft secured approval to acquire Activision, a move that is expected to bolster its video game revenues by a whopping 50% to $24 billion. 2. McDonald's. Over the years, McDonald's has seen some changes, from upgrading its coffee offerings to the occasional return to the McRib sandwich. Even the beloved character Grimace has returned and is more popular with kids than ever. However, at its core, McDonald's remains true to its roots since its establishment in 1955. It still serves up its iconic burgers, fries, and soft drinks, catering to customers seeking a quick and convenient meal on the go. This strategy continues to be successful, which is evident in the MCD stock hitting an all-time high, climbing 11% in the past year. While MCD stock may no longer dazzle with flashy growth, it remains a reliable choice for long-term investors, steadily compounding returns over time. It's also renowned for being one of the top dividend stocks in the market. McDonald's has been paying dividends since 1976, consistently increasing payouts to shareholders yearly. Currently, MCD stock offers a quarterly dividend of $1.67 per share at 2.24%. With strong earnings driving its performance, the stock has been steadily climbing and recently surpassed the $300,000 mark for the first time. 3. American Express. Affectionately known as Amex, American Express stands as a global frontrunner in credit card and payment services, catering to consumers and businesses with diverse products and solutions. While its dividend yield may appear modest at 1.14%, especially compared to other financial services giants, Amex more than makes up for it with a robust dividend growth rate. Over the past 5 years, this titan of credit card and payment services has consistently upped its quarterly cash distributions by an impressive average of 8.9% annually. But Amex doesn't stop there in its efforts to reward shareholders. The company has significantly reduced its outstanding share count by a healthy 13.7% over the past half-decade through regular share buybacks. Such buybacks enhance earnings and signal management's confidence in Amex future prospects. Beyond its commendable financials, Amex demonstrates exceptional growth potential and formidable competitive edge. Analysts project revenue growth rates of 9.2% in 2024 and 8.4% in 2025, outstripping many competitors, particularly with its focus on premium and ultra-premium cards catering to low-risk customers. Adding to its allure, Amex boasts a prominent endorsement from none other than Warren Buffett's Berkshire Hathaway, a loyal shareholder since the 1990s. So it's a pretty solid company. 4. Starbucks. This one stands out as a dividend growth gem, providing investors a steady income stream. Renowned for its global network of specialty coffee shops, Starbucks has impressively increased its dividends by an annualized rate of 9.62% over the past 5 years, currently boasting a yield of 2.43%, surpassing the average of its large-cap peers. In addition to its dividend payouts, Starbucks also actively rewards shareholders through share buybacks, reducing its share count by 8.8% in the last 5 years. This strategic move not only enhances earnings but also bolsters valuation. With a payout ratio of 57.5%, Starbucks remains in a strong position to maintain its aggressive dividend growth policy. Starbucks' robust revenue expansion is fueling its growth trajectory, driven by its global expansion initiatives and loyal customer base. Analysts anticipate an impressive 18.6% surge in sales for fiscal 2024 and 2025, a remarkable feat for a mature business. Moreover, Starbucks garners favor among institutional investors due to its solid long-term prospects and compelling value proposition. Heavyweights like Vanguard and BlackRock have significantly increased their stakes in Starbucks recently, highlighting their confidence in the company's future trajectory. Number 5. Nike. They have built an extraordinary legacy since its IPO in 1980, boasting a staggering total return of over 92,000%. As the undisputed leader in footwear and apparel, Nike's brand power is unparalleled, evidenced by its ranking as the 13th most valuable brand by Kantar brands, surpassing giants like Coca-Cola, Tesla, and Netflix. This brand strength is significant for investors, with companies like Kantar Brands Top 100 consistently outperforming the S&P 500 since 2006. Furthermore, Nike's dominance is reaffirmed by Piper Sandler's 2023 survey, which found that it remained the preferred choice among U.S. teenagers for footwear and apparel. With 61% and 35% of respondents favoring Nike, the company is well positioned for growth. Financially, Nike offers investors a 1.4% dividend yield, utilizing just 40% of its net income, leaving ample room for growth. With an impressive annual dividend growth rate of 11% over the past 5 years, Nike presents an enticing opportunity for those seeking passive income. Despite recent setbacks due to a challenging consumer spending environment, Nike remains steadfast in its commitment to rewarding patient investors. 6. Home Depot. This one reigns supreme when it comes to home improvement supplies. Much like Nike dominates activewear, particularly in the US, as the world's largest home improvement chain boasting over 2,300 stores, primarily in the US, but also spanning Canada and Mexico, Home Depot continues to eye expansion opportunities, recently added 7 new stores in its fiscal 2023 fourth quarter. However, the home improvement sector, like many others tied to housing, has felt the sting of the interest rate. Home Depot witnessed a 3% dip in sales and comparable sales year over year, with earnings per share also taking a hit, sliding to $3.81 from $4.24 in the previous year. Despite these challenges, Home Depot remains committed to enhancing the customer experience, fostering long-term loyalty and driving sales. Furthermore, digital orders increased by 5% year over year, showcasing the effectiveness of its approach. currently facing a bit of pressure amid economic uncertainty, Home Depot remains well positioned to capitalize on the leading market position and diverse shopping options. Forward-thinking investors should focus on its resilience and anticipate higher sales when economic conditions improve. With a dividend yielding 2.35% at the current share price, Home Depot presents an enticing opportunity as a long-term investment, making it a fantastic addition to any diversified portfolio. Number 7. Visa. It's one of the premier payment network providers worldwide, recognized by its famous brand and logo. With millions of transactions conducted daily using Visa-branded credit cards, the company earns a steady stream of revenue, benefiting from the ongoing shift away from cash and checks towards electronic payments. This robust business model has fueled Visa's impressive financial performance over the past decade, with notable growth in revenue, earnings, and cash flow. Notably, Visa's dividend payouts have soared by a remarkable 420% during this period, showcasing its commitment to rewarding shareholders. While not classified as a dividend king, Visa's dividend growth trajectory remains impressive. Looking ahead, Visa is poised to continue its trajectory of success, largely due to its near duopoly status among its primary competitor, MasterCard. Visa's formidable network effect makes it challenging for potential challengers to disrupt its dominance in the payment industry. Although some may question Visa's growth prospects given its widespread adoption, the company sees significant expansion opportunities, particularly in developing countries where cash and check usage persists. As economies evolve and consumer spending increases, Visa anticipates continued growth potential. 8. Market access. Delivering remarkable total returns exceeding 1,700% since its IPO in 2004, Market Access has emerged as a trailblazer in modernizing bond trending. Yet, despite this phenomenal growth, the company's trajectory is poised to continue ascending. Despite its prevalence of cutting-edge technology, CEO Christopher Garosa reveals that a significant portion of U.S. high-grade and high-yield bonds and emerging market bonds are still traded manually, contrasting with Market Access's digital all-to-all platform. Garosa anticipates that electronic bond trading will mature further, potentially capturing over 80% of trades in each bond category, underscoring Market Access's potential for sustained growth. While this long-term growth outlook holds promise for investors, Market Access has faced challenges due to subdued market volatility, which impacts its financial performance. Despite short-term headwinds, Market Access remains committed to shareholder value, offering a 1% dividend yield that has grown by an impressive 12% annually over the past decade. With only 44% of the company's net income allocated to dividends, Market Access is well positioned to reward investors while they await a potential upswing in electronic bond trading. With a solid dividend track record and a pioneering role in digitalized bond trading, Market Access continues to be an intriguing prospect for investors seeking long-term growth potential. 9. Medronic. Being a pioneer in the healthcare sector is a surefire way to establish a resilient business, and Medronic exemplifies this perfectly. As a long-standing leader in medical devices, Medronic has been at the forefront of innovation for decades, offering essential products for physicians and patients. Its diverse portfolio spans key areas including neuroscience, diabetes care, medical surgical, and cardiovascular care. Despite encountering challenges, particularly amid the pandemic and its aftermath, Medronic remains poised for a promising future. The company continues to innovate, incorporating artificial intelligence, AI, a burgeoning frontier in healthcare. Additionally, Medronic is forging ahead with its development of the Hugo robotic-assisted surgery system, tapping into a sector with immense potential for expansion. With its strong track record of delivering solid financial results and an unwavering commitment to innovation, Medronic has increased its dividend for 46 consecutive years, positioning itself to potentially join the elite ranks of dividend kings soon. Currently offering a solid yield of 3.26%, Medronic's impressive performance and robust business fundamentals suggest that it will continue to thrive and reward shareholders with consistent payout increases for the long haul. Last but not least on our list is Paycom. It is a leading provider of cloud-based human capital management solutions, offering a range of tools for talent acquisition, time and labor management, payroll, and human resources. Since its IPO, Paycom has achieved a remarkable growth, increasing its value 12-fold in less than a decade. The launch of BD's automated payroll solution in 2021 marked a significant milestone for Paycom, resulting in a notable reduction in payroll errors and omissions for its customers. While this development bodes well for long-term consumer satisfaction, it has temporarily impacted Paycom's growth rates, as the company's previously generated revenue from rectifying these errors. This trade-off between short-term challenges and long-term benefits makes Paycom an intriguing investment opportunity, particularly with its stocks experiencing a 40% decline over the past year. Despite these near-term hurdles, Paycom's offerings remain highly valued among its customers in the HCM niche. Furthermore, Paycom's commitment to shareholders' value is underscored by its new 0.8% dividend yield, with management anticipating annual increases. With only 26% of the company's net income allocated to dividends, Paycom presents a potential dividend growth story in the making. Well, that's all from our list. What are your thoughts on these remarkable companies? Have you invested in any of them? Or are you planning to? Let us know in the comment section below. And don't forget to give this video a thumbs up and subscribe to our channel for more insightful content.